It's another week at the Dukacsopy TV Centre, and we are joined once again by our resident financial expert, Dr. Frank Hollenbeck, who is here today to discuss with us credit default swaps. Thank you very much for coming in again. Now, this discussion over credit default swap has come about as it emerges that 5 large US banks are using CDS to theoretically cut their exposure to the European debt crisis. Can you give us a bit more background on this? What's led up to this?
Let me explain what a credit default swap is. It's a sophisticated word for insurance. Just like your car insurance, it's basically insures the possibility of default on a government bond. In other words, if I'm a bank and I purchase a government bond from Greece, then I can buy insurance, which is called a credit default swap, from an insurance company, but it's not really an insurance company, it's another bank. Okay. One of the mistakes that happened back in October of last year is that the governments indicated that they wanted a voluntary haircut on Greek debt. Now, you have to understand is that if you've purchased a Greek bond, if you've purchased insurance, you consider that you're not at any risk. But because it's voluntary, okay, it's a 50% haircut, and because it's voluntary, we have a situation where the International Swap and Dealers Association will not call it a credit event. And if they don't call it a credit event, then the credit default swap doesn't kick in and you don't get your insurance. So we have a situation where a lot of banks had Greek debt, and all of a sudden they found that their insurance was worthless. And that's one of the reasons that interest rates in peripheral countries like Spain and Italy went up in October, November, December, is because we had a large group of investors who would not purchase these bonds unless they were riskless. And with this possibility that we could have a voluntary haircut, it basically made these bonds riskier than they were before.
Who is it that's selling this insurance now then?
Well, that's one of the problems that we have is that the sellers are other banks. And the problem with what we're seeing is that, for example, it may be Italian banks, but these Italian banks are also the ones that are holding very large positions in Italian bonds. So the fear is that if Italy was to default, banks in the United States would say, well, I have a credit default swap. I have insurance on my Italian bonds with this Italian bank. And the fear is it would be exactly like AIG, is that this bank would go bankrupt in the sense that you've taken insurance, like you taking car insurance, and then when your car crashes, you find out that your insurance company has gone bankrupt. So you're basically holding a car that's been totaled and you have no insurance to cover it.
It doesn't seem like a very watertight means of insurance. Are there other actions that banks are taking to try and insure themselves against exposure to the European debt crisis?
In the case of what you just said about the US, their exposure is about 80 billion. And that's the amount of debt that they're holding, and they've insured about 30 billion of that. And generally, in the case of credit default swaps, you know who the counterparty is. That's the thing about over-the-counter transactions, is that they're basically one individual with another, so you know who you're dealing with. And I assume that the US banks have a pretty clear idea of who are the counterparties and the risk that those counterparties are bearing, given the fact that we've known about this sovereign debt crisis for quite a while now.
Do you think it says anything more about the European outlook that banks are looking to try and use this insurance?
The thing about Greece is credit default swaps are usually for 5 years. So they're basically, Greece has been out of the international debt market for since 2010. So a lot of those credit default swaps have been basically expired. And the fear was that the reason they couldn't get an agreement with a lot of banks or a lot of holders of Greek debt was because we have some holders of Greek debt had credit default swaps, and they actually want Greece to go bankrupt, because then their credit default swaps will kick in. We also have a problem in Greece that a lot of hedge funds may have purchased what we call naked credit default swaps. Let me try to explain what a naked credit default swap is. In the example I gave you, you purchase a Greek bond and then you purchase insurance. A naked credit default swap is that you just purchase the insurance. But then what that means is you're kind of hoping that Greece goes bankrupt, therefore that you can pay a relatively small insurance premium and get the total amount of the bond that you've insured, even though you don't hold the bond. And the belief is Germany made naked credit default swaps illegal. They're thinking of doing it for the rest of Europe. I think that's a mistake, because naked credit default swaps makes the market more liquid. Also, naked credit default swaps probably make events occur earlier than the others would have. A lot of people say naked credit default swaps are speculation. And I think I said before, one of the benefits of speculation is that it actually makes event occur before they otherwise would have.
We see it a lot now with countries buying into other countries' debt, with banks now purchasing CDS. Does it not seem to just be making a deeper hole deeper?
The policy of the central bank, which was to extend credit lines at 1% back in December, and there's a high probability that at the end of February they're going to extend it beyond 1 trillion. I thought trillion was a lot. Now we're talking about $1 trillion to $1.5 trillion. And that is to induce banks to purchase more debt. That's definitely taking a situation where banks are already in a deep hole and putting themselves in even a deeper hole.
Dr. Frank, thank you very much. As always, Dr. Frank Hollenbeck will be back with us next week to discuss another financial topic gracing the news headlines. For now though, goodbye.